And so the deal structure that goes into an acquisition, the financial deal structuring, is the heart, lungs, liver of the beast. It's everything. It's not, did I get a good price on dirt, sticks, and bricks, and then go check my financial brain out to get money anywhere at any price. It's deal structure. Okay? I'll give you an example. And this is as simple, again, a deal as you could get, but I'm putting this up here to just kind of, let's get simple. This is 2 blocks away from that waterfront property I just showed you. Another amazing location. I mean, it's right there. It's the best location in Seattle. And here's a 6-unit right here from your informant on the street. You deputize everybody you know. I've got 700 and some informants on the street. If a mouse squeaks in Seattle, I get the first call. If anybody's thinking of selling anything, I hear about it. Because if I get a call from one of my informants, believe me, it's going to be a good day for them to tell me about that bird, right? Okay, so I meet with this guy. This guy has owned this building for a long time. He has a financial planner and an attorney, and the team of them want to get together to talk to me because I've expressed that I want to buy this building. So here's what we come up with. It's a 6-unit building right there, 2, 2, and 2, 1,170 square foot 1-bedroom units, 6 garages on the alley side. Perfect location. Like, doesn't get any better location. And we come up with a 150, and that was a really solid, fair price. Now, if it was listed, it might have gone for $1,350,000, but you know, with commissions and this and that, I bought it as is at $1,150,000. No big, unbelievable wholesale number there. I won't say it's retail, but it's a solid number, right? But now you start looking at it from there on, and this doesn't look normal. $50,000 down buying a multiplex, what would you need to put at Bank of America? 35% with a 1-3 debt coverage ratio, something like that, right? So all of a sudden, I'm buying this building for less than 5% down. Now why? Why would his attorney and his financial planner suggest that? Because of course, he has a zero basis in this building. The more he receives, the more tax he's going to pay. He doesn't want to pay any tax. In fact, he wants to ride this thing out completely, never paying capital gains tax. That's his entire plan. And here's a guy, an old guy, who doesn't have any kids, so he names 6 remainder beneficiaries on the note. Not co-beneficiaries, remainder beneficiaries. Causes: Brea, Kentucky College, UW School of Drama, Habitat for Humanity, those kind of things, right? He named 6 of them. Less than 5% down. $1.1 million on a note, 3.5% interest, fixed, all outstanding principal due and payable, 25 years from closing. Okay. Some people look at that and get hung up on the interest rate. It's like, why are you getting hung up on that interest rate? You don't think anybody would sell their building at 3.5% interest? There's billions of dollars in the bank at 1% interest, right? If you took all your money to Bank of America and said, I want a great CD, you might get 2.25. So 3.5 is solid, right? Especially when the bank of a person doesn't have all that overhead to pay for, right? It's truly money to them, right? Okay, so it's, again, belief system. People say, oh, I can't believe anybody would sell on a note at 3.5%. Well, that's because you believe that. So you don't ask for that. But if you believe differently, you'd ask for it, and then you'd see that actually that happens all the time. Okay, but this is sort of a simple framework. Now let's add a few things that are pretty significant to the negotiation. Okay, one thing that's very significant is I want to be able to substitute the collateral for the note to a different piece of property if I want to. Right now, the note would be collateralized by that subject property. But let's say I had a different property that had $1.1 million of equity in it, that had plenty of cash flow in it. I want to be able to take the collateral from this property to another property. That's the substitution of security clause. I want that, okay? I also want a clause in there that says if he should sell this note in the open market between now and when it's due, that I would get a first right of refusal to purchase the note if he sold it prior to maturity to anyone else. Because he could take that note for $1.1 million, take it to the street, and someone goes, well, I'll give you $700,000 for that note. Great. Well, if he's going to sell that note for $700 cash, wouldn't I want the first right of refusal to buy it for $700 and cash him out at $700? So I'm going to have that in there. You can bet on that. I also want to be able to slice this note up into multiple notes that add up to $1.1 million. Couldn't I create 11 $100,000 notes? And isn't that, if he was the beneficiary of 11 $100,000 notes, isn't that the same as being the beneficiary of one $1.1 million note? And arguably, couldn't it be shown that that is to his benefit to kind of spread his collateral out among other properties? So I want what we call a slice and dice clause, or technically an exchange of note clause, to be able to exchange the big mothership note for a lot of smaller notes, right? Okay, so these are pretty standard what we call lettuce and tomato.